If you want to start investing or you are investing but you're worried about the next couple of years and what could happen to our economy and the global economy, what should you do with your money? I'm going to tell you. But first, you need to smash that follow. This is a safe space for everyone because investing is for everybody. And if you're worried about certain freedoms or rights being taken away, I promise you a diversified investment portfolio is code for freedom. Now, if you're worried about a global economy slowdown or a trade war with China and you're not sure how to invest, here are some things to consider. First of all, Donald Trump announced today or yesterday that he's planning on a $500 billion AI infrastructure package, which is going to be huge for tech stocks. Generally speaking, due to their vast innovation and disruptive nature, technology stocks will outperform the overall markets long term. Short term, of course, there's more volatility, but an ETF such as FTEC or FTech is up over 500% in the last decade. And a lot of the companies in this fund are exposed directly to semiconductors, artificial intelligence, AI boom, quantum computing, which could all see a humongous boost under, I hate to give this guy credit, under Trump with his infrastructure plan. Not only that, but infrastructure could be seen as more broad than just technology. It could fix our telecom, it could fix our power grid. So there's a lot that could benefit. These kinds of investments could do very well over the next couple of years. And if you're interested specifically in artificial intelligence ETFs, Seeking Alpha is a great website. You can go on their search bar and usually type in artificial intelligence ETF or utility ETF or something like that, and it will give you a list of sector-specific ETFs on things that you might be more interested in than just outside of a broad S&P 500 index fund or something like that. But outside of that, if we're worried about trade wars with these tariffs or global economic slowdowns, it means that we need to focus on companies that are either strictly US-based or predominantly US-based. Or even if there are companies that make a lot of their revenue from overseas, they're consumer staple companies, right? Stuff that you're gonna need to buy no matter what. Now, utility companies generate almost all of their revenue from inside the United States. They provide electricity and other utilities to people in the United States. There are companies like Con Ed, which is more, New York based, and Southern Company, which is more Southern based, that provides utilities to people all over the country. We are going to need our utilities, our electricity, no matter what is going on in the world. So companies like this that are US based could insulate your portfolio. Another option where we generate a lot or almost all of our revenue from in the States are telecom companies. You can get a telecom ETF like XTL, which is up 41% in the last year. That's pretty strong. Or you could invest individually in companies like AT&T or Verizon. Take a look at AT&T, $22 a share, up 33% in the last 12 months. There are also consumer staples ETFs that invest in stuff that we're going to buy all the time, whether it's household goods, cleaners, medicine, and stuff like that. And yes, a lot of these companies like Procter & Gamble and Johnson & Johnson and Kenvue generate their income. A lot of their income comes from overseas, but a lot of it is also still based in the States. I know a lot of people don't like dividend stocks. They underperform the overall markets. They underperform growth stocks. They only pay a couple percent in dividends, might not outperform inflation. But the idea for some investors is that it gives them a little bit of insulation in their portfolio. It generates some passive income, and there are still sales and revenue, and the stocks still can grow a little bit over time. It is why it's so important to have a diversified portfolio that, especially if you're younger, you have a lot more tech exposure and a lot more growth exposure, but you can still benefit a little bit from dividends and the passive income they provide and the insulation to your overall portfolio. There are a lot of wrong ways to invest, like dumping your whole life savings into something hugely speculative, but there is no one right way to invest. It's different for every investor. So remember, when you see a guy on TikTok saying dividends are stupid for everybody, they don't speak for you and what is right for you and your own level, your own risk management, and your own risk tolerance. Wait, there's one last thing. If you're looking at all these investments in this video and you go, I don't know how to compare one stock to another. I don't know how to compare fundamental analysis. I don't know which ETF is better and how would I research? I got something for you, and yes, it is 100% free. All you need to do is go right here and click on the menu, which is right here, and all of these resources are free, including my fundamental analysis template and my ETF template. My course is free too. Everything here is free. If you haven't smashed that follow yet, why not?